Good morning, Flagship Harbor Advisors. Eric Jefferson with the core team. Happy Monday. Today is February the 28th, 2022. Just a reminder, this replay is for advisor use only. What a weekend. We saw fighting continue to escalate in Ukraine, coupled with some very severe sanctions from the West. Headlines there, 7 of the largest Russian financial institutions kicked out of the SWIFT system. As well, 630 billion of Russian central bank owned assets were frozen. Again, obviously, the response from the West has been to make this as economically painful as possible on Putin. We'll see, obviously, how that plays out longer term. As well, we saw many in the EU respond militarily, supplying weapons to Ukraine. Many companies, including Germany, vowing to increase their defense spending going forward. Russian stock market is closed today, probably a good thing. We saw the policy rate double from 9.5% to 20%. And as a response, the ruble, the Russian currency, has been absolutely crushed. Again, just to give some context, their stock market down 39% on Thursday. That is the largest single day drop for a country's equity market. So again, kudos to Russia for now having that honor. We did see, interestingly enough, Wednesday night when the invasion was originally announced, a future sell-off very significantly, down about 3% in pre-market trading, and made about a 600 basis point swing back, closing Thursday up about 3%, followed by another risk on day on Friday. That in many parts was led by some encouraging peace talks, which are scheduled for early this week. No expectations there. I think the broader trading pattern, as we talked about in a recent client letter, is that leading up to geopolitical events, that's where typically volatility is most concentrated. Once that event finally occurs, get some guidance on what it looks like, not in any way to downplay the human loss that has occurred thus far. And certainly there are many questions that remain unknown around Putin's endgame and strategy for Ukraine, but not seeing this be a global military response, i.e. the start of World War III, has calmed some nerves. From the investment implications, not surprisingly, as we talked about, oil is higher. The function there, supply and demand. Russia provides about 40% of energy to Europe. Obviously, many of that exchange will be paused for the short term, again, as we wait to see how that situation plays out. Short-term implications there, not surprisingly, inflation will be higher. As well, when we think about all of the chaos going on, if anything, anticipate that has to put some downward pressure on the Fed's response. I think it's fair to say 50 basis point rate hike in March now off the table. We will hear from Powell later this week, but do now expect all eyes on that March 16th meeting, where we will see a 25 basis point rate hike, probably the first of several this year. Taking even a broader step back, just the global implications, the U.S. has very limited or very minimal direct exposure to Russia. Goldman over the weekend revised their GDP forecasts only 10 basis points lower, still targeting the mid 3% for 2022. So again, global growth slowing relative to what it was over the last 18 months, but still above trend. Do still think that is a somewhat encouraging environment. Over the intermediate term rather, I do still favor value, although with the potential for a more muted Fed response, as well coupled with just the extreme sell-off on the growth side, I wouldn't be surprised if we actually nibble a little bit on some of those growth names that we think are maybe a little oversold based upon the environment that we're in. Longer term, though, again, do still have a somewhat healthy preference for value over growth. When you think geographically, again, going into this year, favored Europe in a margin in EM versus domestic. Both IFA and EM have led year to date, although following the Russian invasion, you've seen strength shift to domestic. US has outperformed non-US in that time period. Another theme from just a sector play has been cybersecurity. Again, one of the ways that Russia, in theory, could counteract some of these sanctions outside of direct military escalation, which we don't necessarily anticipate, would likely be in the cyberspace. Those stocks are up double digits following news of that invasion breaking on Wednesday night. When you think about just the macro direction for risk assets, again, plenty of uncertainty around what the future holds for Ukraine, what Putin's endgame is there. But when you look at a lot of the fundamental indicators, things like investor sentiment have nearly bottomed. as well. You saw some strong buying after that initial invasion took place. Small caps, interestingly enough, have actually outperformed large caps. Skew, that's a function of the deep out of the money VIX call options, is actually down significantly from where it was earlier this year. Those all tend to suggest we may be reaching a bottom here. Again, something keeping a very, very close eye on. If we do get those indications, may in all likelihood use this as a buying opportunity. Looking ahead to this week, State of the Union tomorrow night, hear from President Biden. Imagine a lot of that speech will have to be rewritten as of the events as of late. Do expect him to touch on inflation. And again, the thought process there is that you will see the Fed take aggressive action to combat those higher prices. That being said, not sure what impact interest rates are going to have. We still believe that the bigger drivers of inflation here, one, war, and obviously the impact, the upward movement in prices that has on the energy space, which has been by far and away the largest contributor to higher prices. Supply chains, the other. Again, we are somewhat encouraged seeing those continue to work themselves out. One thought just on the energy story. Again, yes, oil prices are teetering around 100 at one point, had dipped north of that following the initial invasion news. We think the fundamental price target for oil closer to 75, give or take. Again, not surprised though to see where it is trading today as a function of everything going on. But when you think about the impact to the end US consumer, interestingly enough, we are consuming less energy today than we were. Again, in the Northeast here, we're wrapping up the winter. Folks are also driving a lot less, whether that's electric vehicles, whether that's rideshare or simply work from home. Again, not consuming as much. Obviously, prices at the pump have gone up, but that significant impact has not showed its ugly head just yet. And what I mean by that is retail sales still positive. Interestingly enough, again, we understand Americans are spending a larger portion of their monthly incomes to buy the same basket of goods and services. But again, where we've talked about a very healthy US consumer today with excess savings, granted, they are starting to draw down on those savings rates, but the encouraging news there is that spending has not been curbed as a result of those higher prices. That is obviously the concern with inflation. When we think about stagflation, where we have higher interest rates to combat inflation in a slowing growth environment. Again, we've not seen that play out as of yet. Obviously, though, something we'll continue to keep a very, very close eye on. Additionally, later this week on Friday, going to hear from labor data, both participation rates, but also hourly earnings. I think the hourly earnings is going to be the key point to emphasize there. Again, we've seen some wage inflation so far, been predominantly isolated to the lower income earners. The question then becomes, as that starts to impact the middle and higher earners, what will that do to prices longer term? Obviously, higher wages paid out directly impact profitability that a company has if they cannot pass along those higher costs to their end consumers. Thus far, that has not been a problem. Again, we've seen that reinforced in some very encouraging earnings reports as well as guidance going forward. So the macro story, we are still fairly comfortable on. That being said, obviously a lot of uncertainty in the short term on the geopolitical front. That's all for now. As always, please let Michael and I know how we can help going forward. Have a great week if you don't connect. Take care.